purchase and execute a short sale, another option, another high-risk investment. There's an awful lot of potential, though, with the investment. So if you're comfortable in the stock market and the bond market and all the different financial aspects of it, but especially in this world of derivatives, keep in mind that a derivative is something that it's deriving its asset value from an underlying asset. So all by itself, a short option or put option here is the aspect of it's going to draw its value from an underlying asset again. So we call that a derivative. So what is it? The seller sells an option contract to a buyer without selling them the underlying asset. The seller is obligated to deliver that asset if the option is exercised. So you're selling the right of purchasing your asset at a determined price by a certain date to somebody else, and that's what we call a short sale. So why do they do that? To generate income. If you think you have stock and it's sitting over here at $80 a share and you think it's going to hit $100 and you're confident about it, and somebody's willing to sit down there and buy that stock at a certain fixed price, or actually make you buy the stock at a certain fixed price, they'll make money and you make money in the process. It's a hedge against risk. Option sellers use the short sales to hedge against your exposure with that underlying asset. If an investor owns a stock, they're worried about it going down, they could sell a put option on the stock. This would give them to sell the right to sell the stock at that strike price, even the market falls below that level. Option sellers use these to sit down and speculate on the future price. For example, they believe the stock is going to go down, they could always sell a call option on the stock. So options work both directions. You can actually, in theory, sandwich yourself between the two. It depends how much you want to get involved with that. It can be very confusing, but also rewarding in the process. Let's use a short option example. You believe the stock price of the company XYZ is selling for $100, currently to $100, it's going to rise in the next month. Ta-da! You have every faith that XYZ will come through and save the world. So you're going to sell a put option. Okay, yeah, I'm not worried about it. It's not going to go down. So you sell a strike price of $90 with an expiration date of 1 month. I typically prefer 45 or 60 days, but that being said, so $100, you think it's going to go up, but you're going to insure things and just make some extra money on this side by selling a put option. By selling it, you agree to buy 100 shares of the stock at $90 per share from the buyer of the option. Okay, so in other words, you're thinking it's going to go up. I don't have a problem in the world, and if it drops down to 90, it's no big deal. I'll just buy it there. Okay, so in exchange, you take in the obligation, you get a premium payment from the buyer of the put option. Let's say you sold that because it's a low risk probability at $1 a share. You receive $100 in premium income when you sell the put option, and you're sitting over there watching, and 28 days out, it's like, okay, the stock price remains above $90 at expiration, the put option expires, and you get that extra $100. It goes in your pocket, life is good, you made a smart decision. However, if the stock price at $100, it drops, and all of a sudden you break into a sweat on day 27, day 30 is coming, ding, 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 and it falls below $90 and it's down to $80, you have, the buyer exercises the option and they sell their right, they exercise their right to sell it to you at $90 a share. So all of a sudden now it drops down to 80. You lost some money. You lost money on the initial price, but also now you have to buy your own stock back at $90 a share. And by the time it's all done, you're losing money if you're the seller. The put person, they're making some serious money with a $1 investment because of the fact they short sold it. Now, this goes a long ways because you'll hear stories of people that buy massive amounts of short selling. Okay, they'll go out down there and I found the secret information. This company is doing bad things, bad. They destroyed the whole world in the process because of their manufacturing process. Oh, how dare they go and do this? And they'll find all kinds of scuttlebutt. They might know it ahead of time, or sometimes they fabricate it. The whole goal is to sit down there and wish illness upon whoever that is. Short sellers are probably the most hated stock investors on the market by people that are selling the stock and the corporate owners. So, and their job is to go out and find the dirt on somebody so they'll sit down and expose them for what it is, not because they're nice people and good souls, because they want to make money. Okay, so short sellers, they have a reputation, but they also have an opportunity to sit down, make money But people that sell short, they can also insulate themselves in regards to that. So how do you go about selling the short option? Okay, you need to open a brokerage account. Once you have it in place, in order to sell the option contract. So pay attention to that. I always recommend, if you're going to go to the trouble of opening a brokerage account, make certain that you have the opportunity to buy stuff on margin as well. Type of option, make sure you place the order, a call or a put. Okay, identify the strike price that you think it's going to be at, and have an expiration date. And once you place your order, your broker is going to execute the contract. You'll have a small fee, and make sure you know what that is up front. Short selling options is a risky strategy, but all options are risky. So make certain that the underlying asset moves against you. You could lose a lot of money. So that being said, be careful on it. But if you buy an option, if you're the one buying the option, then it just expires. You've only lost that amount of money. For example, if you sell a call option in the stock and the price goes up, the buyer exercises the option, you'll be obligated to deliver at the strike price. If whatever it is, you lose money on the trade. Pay attention to the short selling options, the price you could pay. If it drops like we showed in the illustration, you could be out some serious money because you took a risk in the process of the option that went past your stock value itself. Selling covered calls, when you sell a call option to stock the investor already owns, the price doesn't rise above the strike price by expiration, the option's worthless. Selling naked puts, okay, they have close, okay, but they don't rest. The close fall off after a while. So they sell the put option without owning the underlying asset. If the stock price falls below the stock price of the option, the investor is obligated to buy the stock at the strike price. It's riskier than selling covered calls, but it has potential to generate higher returns. It's a tool that you use to sit down and cover different things. I grew up in a household where we're always doing options and everything else. It's a matter of you always had to have a bottle of Tums next to you when you're on your computer watching all this, because you're watching all this going up and down and your stomach is turning out acid nonstop. So it's one of these exciting moments that you always have. Generate incomes with an option. Another example, 100 shares of stock ABC trading at $45 a share. Investor believes the stock price is going to be stable, so they sell the covered call with a strike price of $52. An expiration date of 3 months. The investor gets $2 a share, so they're making $200. The stock price remains below 52, that option expires, ta-da, you made $2. However, if the stock price rises above 52, okay, the option holders exercises the right to buy it at $52 a share, and it might hit $65 a share, and all of a sudden you did make the $2, except for the fact that if it went up to $65, you lost $13 a share. That's the price of doing the short sales by playing the game. So you get the profit, your maximum loss $7 a share. Investors' potential is limited to monetary premium, so you have all those. Choose the right options. Not all options are created equal. There's a lot of volatility in all options, and pay attention to that expiration date. Cover yourself with stop loss orders when it reaches a certain price. And that way the computer makes the decision when you're off taking a nap someplace else. Manage your risk and be careful. Option sales, either calls or puts, they're risky, but they can generate income if you're watching carefully. But no matter what happens, they have a high level of risk. I recommend you get your own personal financial advisor if you're going to dive into this. It's exciting and terrifying, usually all in the same breath, in the same moment, whenever. Take care.